questions, of course, between now and perhaps as far as the end of the year will be the degree of uncertainty that investors have about the political landscape in the U.S., the kinds of policies that will come, and even when that U.S. president will be named. Just today, of course, lots of focus on U.S. President Donald Trump's tax returns splashed across 6 pages of the New York Times. How does that change the investor sentiment out there? Kevin O'Leary is with us, chairman of O'Leary Group. Great to have you with us, Kevin, as always. And I did want to start right there with how the turmoil plays into you. There's so much uncertainty. In any election year, we know markets kind of tend to have a bit of a wait and see volatility to them. This one feels a little more volatile than most.
Definitely. You know, the one thing that I think we all have learned, starting from the Brexit vote and then votes in Canada, the U.S. district votes, Switzerland, France, polls today do not predict outcomes. And so it's extremely hard as an investor to try and gauge the outcome of this election, which is, you know, just days away, and the policy shifts that would occur under Biden versus Trump. But the last time I paid for poll data was the Brexit vote, because I had a large exposure in British pounds, Swiss francs, and euros. And they guaranteed basically 2% variance of, you know, results, and they were completely wrong. And since then, I've ignored it. So I'm preparing for, you know, volatility, as you said, and certainly even in our own recent elections for the conservative leadership race, polls got that one wrong too. So the data's useless. It's entertaining but useless, and you have to just ride the wave, ride the volatility until you know the outcome with certainty.
And is it something you would do, Kevin, to try to invest one way or the other based on outcomes one way or the other? I mean, people try to sort of price in a Biden presidency and what that mean, you know, on taxes, et cetera. Is that wrong-headed? Do you just keep your investments and stay the course through it all?
No, you have a good point here, Amanda. There is an investment thesis versus Biden versus Trump, and I'll give you an example. I no longer own any of the energy sector in the U.S. or Canada, and I've been waiting for a time to re-enter and maybe make that up to 18% of my mandate. And I can't do it right now because if I knew with certainty that Trump was going to get in and that the regulatory environment would remain the same, this would be a good time to be entering in and buying and start to buy some positions. But I don't know that. And I have to risk that Biden, who would probably re-regulate energy, he's already talked about the new Green Deal, and his tone towards hydrocarbons would be completely different. And so I'd want to make my entry point after he took control, you know, in January, because that sector would go down significantly more, knowing that it was a very unfriendly White House towards their, you know, mining of hydrocarbons out of the ground. It would be extremely negative, but a great buying opportunity. So I'm stuck. And that's a good example of, you know, not being able to make a move until I know the outcome. The same thing in Canada. I mean, clearly you would want to go long Canada if you knew you had a more pipeline-friendly outcome in the next election, whenever that's going to be. But you wouldn't make the move now because there's no guarantee anything's going to change in Ottawa.
I'm interested that you're thinking on energy, and you've been a long-time energy investor, so that, you know, you've spent many years in this sector. I'm interested that it's being shaped politically when it seems as though the energy companies themselves are actually changing their own view about the future. That, you know, history is kind of moving on from energy, and we're seeing the biggest players writing down the value of assets and moving their future capital spending elsewhere. Does that, on its own, not change your view of the sector?
Well, the opportunity for energy is this. Here's the investment thesis. You're absolutely right. CapEx is being slashed to maintain dividend yields. And so for the first time since I've been an investor for, 40 years in energy, I can talk to a CEO of an energy company. He'll tell me he's going to or she's going to reduce CapEx by 30% next year just to support dividend yields, which in some cases are north of 6%. And so you've got a situation where they know that the future is not hydrocarbons, but you've got at least 20 to 30 years while this is still a major force in terms of how we provide energy to the economy. So you want to take that balance and say, well, if I want, I can buy 30-year bonds and make less than 200 basis points, or I can find a company that has strong cash flows that's going to manage itself and make 6%. That's why there's institutional interest in energy. Unfortunately, in Canada, we don't have that institutional interest. Fund flow.
Oh, I feel like we've lost Kevin's audio there. I'm going to give him a second and see if we can get that back. We're certainly obviously been watching the energy sector here. And it's interesting on a day like this when we do see energy leading the markets higher. The betting, of course, about where the future of this sector goes has been of major consequence. It isn't just the major players that are trying to determine where their own capital flows will go, but we've seen some of the world's biggest investors, including pension funds, our own included, changing their outlook, or at least their stated outlook on how they'll invest. And Kevin, so we lost you for a little bit there, but just talking about how the world's biggest investors are also changing their thinking on energy, and partly that's perception driven, right? It doesn't look good to be an oil sands investor anymore, and that makes it tough to tell your investors that that's where you are.
Well, that on top of litigating anybody who tries to invest money in oil sands and tie them up in court for decades, that doesn't make it a very interesting opportunity. And unfortunately, we have landlocked energy, and that's really hurt. The thesis that most countries have tried to adopt is to put a 25-year horizon on those assets. Europeans have done this. Obviously, the Saudis are doing the same thing, and take the proceeds of those cash flows and invest them in other sources of energy and other aspects of the economy. That's what we've missed out on Canada. We could have had very strong cash flows from our sector. They have collapsed. The jobs have gone. We still end up in court everywhere. I'm obviously critical as an investor, and I try and stay bipartisan on it. But in managing the decline and the free cash flows, we've done a poor job. Other countries, at the same time we did this to ourselves over the last 6 years, the U.S. has become energy independent. Sure. Even at a $36 oil, we missed that opportunity. I don't know who to blame for that, Amanda. Maybe you can figure it out.
Well, you can always come back and run and really find the right person to blame. On that front, though, when we think about kind of the fiscal sustainability of countries, the U.S. is far and away one of the worst culprits on the planet. At what point, if ever, do you start to? It seems so boring these days and kind of trenchant to make people talk about deficits and looming debt and the future generations. But there you are; it's all out there. Do you worry about the U.S. and a devaluation of the dollar one day?
Yeah, it's an interesting issue, but right now the focus is not on the environment, unfortunately. The focus is on getting past this pandemic, not just domestically or in North America, but globally. We've got to come up with therapeutics and a vaccine for this, and it's probably going to take a couple of years to go through the system. The trend everywhere, though, if you look at new products, consumer services, everybody is getting focused on sustainability, not as a marketing ploy, but they're getting engaged because consumers want change. They don't want to throw plastic in the ocean. Mm-hmm. They don't want poor water quality. They don't want bad air. And so the economy, as long as you can keep it buoyant, you can adjust the way you run it. And that's the whole thesis around keeping the economy strong. Now, everywhere you go, there are massive deficits building up, and you've got to pay the piper on that at some point. But the best way to do that is to spring right back, get full employment, and figure out a way to just continue to grow the economy. That takes care of all problems. So you need very pro-business policies in any country you're in, and that's going to be the balance. I anticipate if Biden wins, he will not raise taxes because unemployment in the U.S. will be 9%. So before he ever does that, he'll try and get employment back to unemployment under 4%. He is of the age that he will probably not send a second term. So I think a Biden presidency will be very benign. He'll maintain a hard stance on China. In some ways, it won't change much from what the policies that are right now, because his hands are tied to get employment back to where it was, just 6 months ago.
All right, Kevin, always great to have your thoughts. Appreciate it. Kevin O'Leary is chair of the O'Leary Group.